Welcome to our journey through the complex and fascinating world of business finance and business management. In a world where financial headlines can make or break markets overnight, understanding the nuances of business finance has never been more crucial. Whether you're an aspiring entrepreneur, a seasoned business manager, or simply curious about the financial forces that drive the business world, you're in the right place. Did you know that 82% of businesses fail due to poor cash flow management, according to a U.S. bank study? Or that companies on the S&P 500 list in 1958 remained there for an average of 61 years, but by 2011, the average tenure had dropped to just 18 years, as reported by Innosight? These shocking facts highlight the volatile nature of business and the critical role finance plays in sustaining and growing a company. In this series, we'll embark on a 10-chapter voyage, uncovering the secrets of business finance. From the basics of understanding financial principles to the complexities of global finance and the future trends reshaping the business landscape, we're covering it all. We'll explore why businesses need to master financial planning and analysis, how investment strategies can propel a business forward, and the importance of managing risks in a fluctuating financial environment. But that's not all. We'll dive into the significance of financial reporting and compliance, unravel the impact of technology in transforming financial operations, and navigate the intricacies of managing finances on a global scale. With the business world evolving at an unprecedented pace, staying ahead of future trends in finance has become imperative for success. So, whether you're looking to refine your financial management skills, explore innovative financing options, or simply gain a deeper understanding of the financial strategies that drive successful businesses, this series promises to equip you with the knowledge and insights you need. Are you ready to embark on this financial journey? Let's dive in and discover the powerful role finance plays in the world of business management. Chapter 1: Understanding Business Finance. Welcome to the world of business finance, a crucial arena that shapes the destiny of companies big and small. At its core, business finance is the backbone of every decision-making process in an organization. It's not just about balancing the books or keeping the lights on. It's about strategic planning and making informed decisions that drive growth and sustainability. Why is business finance so important, you ask? Well, imagine sailing a ship without a compass. You might have a general idea of where to go, but without precise navigation tools, you're likely to drift off course. Similarly, business finance provides the compass and map for navigating the complex world of business. It involves understanding how money flows into and out of your business, identifying investment opportunities, and ensuring you have enough cash to cover your day-to-day operations. One fascinating aspect of business finance is its ability to predict future trends. By analyzing financial data, businesses can forecast future revenue, identify potential financial challenges, and prepare accordingly. This forward-thinking approach is what separates successful businesses from the rest. For example, companies like Apple and Amazon excel not just because of their innovative products but also because of their exceptional financial management strategies. Chapter 2: Types of Business Financing. Navigating the world of business financing can feel like exploring a vast ocean of options. Each financing method comes with its own set of advantages and challenges, making it crucial for businesses to choose the right fit for their needs. Let's dive into the primary types of business financing: debt financing, equity financing, and internal funding. Debt financing is akin to taking out a loan. You borrow money and agree to pay it back over time, with interest. It's a popular choice for businesses that prefer not to give up ownership stakes. A classic example is a small business loan from a bank. The beauty of debt financing is its wide range of options, from bank loans to credit lines, each catering to different business needs. However, it's essential to consider the repayment obligations, as they can impact your cash flow. Equity financing, on the other hand, involves selling a portion of your business to investors in exchange for capital. This method is often associated with startups and high-growth companies. A well-known example is venture capital funding, where investors provide capital in hopes of significant returns as the business grows. The advantage here is that there's no obligation to repay the funds, but it does mean giving up a share of your company and, potentially, some control over business decisions. Internal funding, or bootstrapping, involves using your own resources to finance your business. This could mean reinvesting profits, minimizing expenses, or even using personal savings. The advantage of internal funding is the complete control it offers over the business. It's a testament to financial discipline and commitment, as seen in the early days of tech giant Dell, when Michael Dell started his company with just $1,000 and a game-changing vision. Choosing the right type of financing is critical. It influences not just your company's growth trajectory but also its day-to-day operations and long-term sustainability. By understanding the nuances of each option, businesses can strategically position themselves for success, whether they're just starting out or looking to expand. Chapter 3: Financial Planning and Analysis. Diving deeper into the essence of business finance, we encounter the pivotal process of financial planning and analysis, FP&A. This isn't just about crunching numbers, it's about crafting a roadmap for your business's future. FP&A acts as the guiding star for businesses, helping them navigate through the murky waters of financial uncertainty towards sustainable growth and profitability. At its heart, financial planning begins with setting realistic goals based on both qualitative and quantitative analysis. It's about asking the right questions. Where does the company want to be in 5 years? What resources will it need to get there? This planning phase often involves creating detailed budgets that project both revenues and expenses. A well-crafted budget is like a financial blueprint. It outlines how resources will be allocated to meet business objectives while maintaining operational efficiency. However, financial planning is not a set-it-and-forget-it task. It requires continuous analysis and adjustment. This is where financial analysis comes into play, offering a microscopic view of the company's financial health. By analyzing financial statements, companies can assess their profitability, liquidity, and solvency. One compelling case study of effective FP&A is the tech giant, Google. Its ability to continually adapt its budget and investment strategies based on detailed financial analysis has been key to its enduring success and innovation. Moreover, FP&A involves a keen understanding of the market and competitive landscape. It's about leveraging financial data to forecast future trends and prepare for potential challenges. For instance, during the COVID-19 pandemic, companies that quickly adjusted their financial plans based on evolving market conditions were better positioned to weather the storm. In essence, financial planning and analysis is not just a task for the finance department. It's a strategic exercise that touches every part of the organization. It empowers businesses to make informed decisions, mitigate risks, and seize opportunities for growth. Chapter 4: Cash Flow Management. Cash flow is the lifeblood of any business. It's not merely about the amount of money that flows into and out of a business. It's about the timing and management of that flow. Effective cash flow management is critical for maintaining the solvency and operational efficacy of a business. Without it, even the most profitable companies can find themselves struggling to meet their financial obligations. The art of cash flow management revolves around meticulous planning and strategic execution. It begins with understanding the difference between profit and cash flow. A business can be profitable on paper but still face cash shortages if its capital is tied up in inventory or receivables. Therefore, managing cash flow involves monitoring these key components, ensuring that cash inflows match or exceed outflows. One strategy for improving cash flow is through invoice management. Offering early payment discounts to customers can encourage faster payment, improving cash inflow. Additionally, renegotiating payment terms with suppliers to extend payables can help manage outflows. A notable example of effective cash flow management is Apple Inc. The company meticulously manages its cash flow through strategic inventory management and supplier negotiations, maintaining a robust cash position that supports its extensive R&D and innovation initiatives. Another critical aspect of cash flow management is maintaining an emergency fund. Unexpected expenses or downturns in revenue can strain financial resources, making it essential to have a cash reserve. This fund acts as a buffer, ensuring that the business can continue operations and invest in growth opportunities even in challenging times. Chapter 5: Investment Strategies for Businesses. When it comes to securing the future of a business, strategic investment plays a pivotal role. It's not just about squirreling away profits. It's about making your money work for you, fostering growth, and ensuring long-term sustainability. Investment strategies for businesses range from expanding operational capacities to entering new markets or even acquiring other companies. The key lies in making informed decisions that align with your company's goals and risk tolerance. One fundamental approach is diversification. Just like individual investors are advised not to put all their eggs in one basket, businesses too can benefit from spreading their investments across different areas. This could mean investing in new product lines, geographic expansion, or different asset classes. Diversification helps mitigate risks and can lead to more stable financial performance over time. An iconic example is Amazon's leap from an online bookstore to a global e-commerce giant, cloud service provider, and beyond. This strategic diversification has been instrumental in Amazon's explosive growth and market dominance. Another critical aspect of business investment strategy is timing. Investing too early or too late can both have their drawbacks. Market research, trend analysis, and financial forecasting are essential tools that help businesses decide the optimal time to make their move. For instance, Netflix's shift from DVD rentals to streaming services just as internet speeds were improving globally. This timely transition capitalized on changing consumer behaviors and technology advancements, setting Netflix on a path to become a leader in digital entertainment. Return on investment, ROI, is the ultimate measure of an investment success. Businesses need to evaluate potential investments not just in terms of possible financial returns, but also how they align with the company's broader strategic goals. Investments in technology, for example, may not only improve operational efficiency but also enhance customer satisfaction and open up new revenue streams. Chapter 6. Risk Management in Finance. Risk management in finance is akin to navigating through a storm. It's about anticipating, identifying, and mitigating threats that could capsize your business. Financial risks come in various forms: market risks, credit risks, operational risks, and even geopolitical risks. The goal of risk management isn't to avoid risk altogether. That's impossible. But to understand and manage these risks to minimize their impact on your business. A starting point for effective risk management is risk assessment. This involves systematically identifying all potential risks that could affect the business, assessing their likelihood, and determining their possible impact. This process helps businesses prioritize risks and allocate resources more efficiently to manage them. One of the most powerful tools in risk management is hedging. This involves taking steps to offset potential losses from adverse events. For example, if a business is exposed to currency fluctuations because it operates in multiple countries, it can use financial instruments like futures and options to hedge against currency risk. This was effectively demonstrated by Southwest Airlines in the early 2000s when it hedged fuel prices, saving billions during times of rising oil prices, unlike its competitors who faced huge costs. Diversification, not just in investments but also in revenue streams and supply chains, can also mitigate risks. Relying on a single product, market, or supplier can be risky if that area faces a downturn. By diversifying, businesses can spread their risk and reduce the impact of any single negative event. Lastly, a culture of risk awareness and continuous monitoring is vital. Risks are not static. They evolve as the business and external environment change. Regularly reviewing and updating risk management strategies can help businesses stay ahead of potential threats. Risk management is an integral part of financial planning and decision-making. By understanding and mitigating risks, businesses can protect their assets, ensure stable growth, and navigate the uncertainties of the business world with greater confidence. Chapter 7. Financial Reporting and Compliance. Financial reporting and compliance might not be the most glamorous aspect of business finance, but they're undoubtedly among the most critical. This isn't just about ticking boxes or filling out forms. It's about transparency, accountability, and building trust. Financial reporting provides stakeholders with a clear picture of a company's financial health, while compliance ensures that businesses adhere to laws and regulations, safeguarding both the company and its customers. The cornerstone of financial reporting is the preparation of financial statements, the balance sheet, income statement, and cash flow statement. These documents offer insights into a company's operational efficiency, financial stability, and cash management practices. For example, a healthy balance sheet with strong assets and manageable liabilities signals a robust financial position, attracting investors and facilitating access to finance. Compliance, on the other hand, involves adhering to a myriad of financial regulations, which can vary significantly from one jurisdiction to another. These might include tax laws, securities regulations, and industry-specific guidelines. Compliance is not just about avoiding penalties, it's about operating ethically and sustainably. The Volkswagen emissions scandal is a stark reminder of the potential consequences of non-compliance, not just in financial terms but also in terms of brand and reputation damage. One trend transforming financial reporting and compliance is the adoption of technology. Digital tools and platforms are making it easier for businesses to manage their finances accurately and transparently. Blockchain technology, for instance, offers a way to create immutable records of transactions, enhancing the reliability of financial reports.